You go long one stock and short the other, 1-to-1. Same dollars on each side, so it's market neutral. But plot the spread and it keeps walking off in one direction. A trend that stays is a trend you didn't hedge. The real ratio wasn't 1-to-1, it was 1-to-1.74, and that number comes out of a spreadsheet in about 30 seconds. If you have ever searched how to calculate a hedge ratio in pairs trading and come away with 3 different answers, this is the one that settles it. We've been circling the cointegration coefficient for 3 parts now. In part 11, we looked at how you find it. You vary the coefficient, and you take the value where the autocorrelation of the spread bottoms out. In part 12, we looked at what that value means. When the coefficient is 1, the 2 prices meet at an equilibrium point, and the closer it sits to 1, the smaller your risk. But I kept putting one thing off. Why is that method legitimate in the first place? Why does minimizing an autocorrelation have anything to do with maximizing stationarity? And why the cointegration coefficient at all instead of beta? Today we answer both, and we start with our hands, by actually computing it. One note on where today sits. The basic series ended without this. The advanced series ended without it too. The ground underneath the whole method was the part left unresolved. Today's 3 topics are that missing ground, and they make this the most theoretically complete stretch in the series. Let's go back to the cold open properly this time. Today's pair is Emerson Electric and Honeywell, 2 large American industrials, both in factory automation. I used 2.5 years of daily closes, 606 trading days. I set the coefficient to 1, a straight 1-to-1 hedge, and plotted the spread, and the spread drifts about 6.3% a year in one direction, and it doesn't come back. Here's exactly why that's a problem. The spread is supposed to be what's left over after the common trend has been removed. If a trend is still sitting in the spread, then what's left isn't pure residual. The common trend in those 2 assets did not cancel, which means a 1-to-1 long-short portfolio is not market neutral. So what ratio is right? Change the coefficient and the stationarity of the spread changes with it. So find the point where stationarity is highest. And here we use the equivalence from part 11. Maximum stationarity is the same thing as minimum autocorrelation at lag 1. Why those are the same is what we prove at the end of today. The spreadsheet procedure is 3 steps. Step 1. Compute the autocorrelation. Excel has no autocorrelation function, but you can build one out of the ordinary correlation function. Take the spread column and take the same column shifted down by 1 row and correlate the 2. Every value gets compared against its own previous value, and that's an autocorrelation. It differs slightly from the strict definition, but as a working approximation, it's fine. Step 2. Open Solver. Point the objective cell at the autocorrelation cell you just built and set the goal to minimum. Step 3. Set the cell to change to the coefficient. Run it. Solver walks the coefficient until the autocorrelation is as small as it can get. Now look at what it found. Sweep the coefficient from 0.2 up to 3, and the autocorrelation traces out a valley. The 1-to-1 point is partway up the slope. The floor of that valley is at 1.74. Solver simply rolled down the hill. 1.74, and you can see it without any statistics. That 6.3% a year drift collapses to 0.4% a year. Gone, essentially. And the spread starts oscillating around its own average. Over 2.5 years, it crossed that average line 41 times, and once it stretches away, it takes about 19 trading days to come halfway back. The meaning of the number is direct. Invest 1-to-1 0.74. Build the long short at that ratio, and the common trend cancels, leaving the residual. For what it's worth, when the original author ran this exact procedure on 2 Korean telecoms back in 2012, he got 1.62. Different country, different industry, 14 years apart, and it landed in almost the same place. That's a coincidence. But it does tell you the procedure isn't fussy about the data you feed it. And if you work in Python, one call to an optimizer does the same job. Let's check the ratio against real prices. I entered where the spread had stretched furthest from equilibrium, 19 percentage points below it, which is about 2.2 standard deviations out. That's the same entry line we drew in part 11, and I closed when the spread came back to equilibrium, 85 trading days, roughly 4 months. 100 shares of Emerson at $131 a share. $13,171 on the long side. The short side has to be 1.74 times that, just under $23,000, and at $245 a share, that's 93 shares. Rounded down to whole shares, at the close Emerson was up $737 of profit. Honeywell was also up, but we were short it, and that leg made $1,698, together $2,436. That's a return of 18.5%, and the spread moved 19 percentage points. Those two agree. It's the same check we ran in part 10, holding at a different ratio. The half-point gap between them comes from two places, rounding 93 shares, which makes the real ratio slightly off 1.74, and the gap between log returns and simple returns that we pulled apart in part 10. Two things to flag here. First, the denominator is the long leg only. Selling short doesn't take cash out of the account, so the initial capital is what you spent buying. That's the leverage point from part 9, still doing its work. A pair is a 2 times exposure, and the percentage looks bigger because of it. Second, the same two dates, hedged 1-to-1, would have returned 12.9%, 18.5 against 12.9, and the spread at the better ratio is more stationary, so the risk was lower too. That's an unusual thing to be able to say. Return and risk normally trade against each other. In part 10, we watched certainty and return pull in opposite directions. Here they improved together. Getting the parameter right is about as close to a free lunch as this gets. Now, the honest framing, that is this pair in this window. It is not a law that optimizing always raises return and lowers risk. And this is one round trip checked by hand, not a back test. No transaction costs, no borrow fees, no dividends. Now the theory. First question. Why not just use beta? You'll remember part 9. In the market neutral model, we set the hedge ratio from the ratio of the two betas, A's beta divided by B's beta. Do that, and the market return term cancels out of the algebra. It was a genuinely beautiful proof, but that method needs two assumptions. First, that each stock's return follows the CAPM market model. In reality, there are industry factors and macro factors alongside the market factor. We already flagged in part 9 that a single factor model is a simplification. Second, that each stock's beta is reasonably stable. Betas move around over time, and there's a precise name for that, assumption error. However wrong the assumptions are, the hedge ratio is wrong by that much. The convenient theory sends you a bill. The common trend model estimates the hedge ratio without those assumptions. How? It runs in the opposite direction. Instead of starting from a model and calculating forward, you start from the result you want and search backward. And what do we want? We want no trend left in the spread, so we tell the machine to find the ratio that maximizes exactly that, which is precisely what we did a few minutes ago. Don't start from your assumptions. Start from the result you want. That's today's way of thinking. Second question. What actually is that coefficient? Start from the ground. If you only buy stock A, you carry trend risk. If the price trends down, you lose. That's all there is to it. But if B trends similarly to A, then buying A while simultaneously selling B makes the two trends offset, and the trend risk shrinks. And if the two trends were perfectly identical, the trend risk would cancel completely. The trend that exists in both A and B is what we call the common trend. The logic follows from there. If a common trend exists between two stocks, and you could decompose each price into a common trend plus a residual, then using the ratio of those two trends as your hedge ratio removes the common trend and leaves the residual, and the stationarity of what remains goes up. A pure residual white noise is about as stationary as anything gets. The intuitive picture is this. Overlay the two prices. The trends are similar, but they don't match exactly. So a one-to-one hedge won't remove the trend completely, but multiply the slope of one trend line by some number, and you can bring the two slopes into line. That multiplier is the hedge ratio, and that is the cointegration coefficient. A coefficient of 1.74 means Honeywell's trend is gentler than Emerson's by that much. You have to scale it by 1.74 before the two overlap. And I have to put a caveat on that picture because it matters. The common trend is an abstract concept. It is not a trend line in the sense of a regression line, and most common trends can't even be drawn as a straight line. What you just watched is a way to understand the idea, nothing more. So there are two outcomes. A common trend exists and it fully cancels. The residual becomes highly stationary. That's the state we want. A common trend exists, but only partly cancels. A trend component survives, the residual is less stationary, and that leftover trend is itself a risk. The drifting spread in the cold open was exactly this. And here's the hidden bonus in this method. Suppose you find the coefficient that maximizes stationarity, and the spread still has a trend in it, and stationarity is still low. How should you read that? It doesn't mean you failed to find the coefficient. It means there is no co-integrating relationship between those two stocks to begin with. If no ratio can remove the common trend, then there's no common trend to remove, and those two stocks cannot be a pairs trade. Let me show you a real one. When I was picking today's example, the first thing I tried was two telecoms, AT&T and Verizon. Same industry, both large caps. Obviously it would work. It didn't. Solver does return a coefficient. It gives you 3.54. But the spread built on that coefficient still slides downhill at about 22% a year. In 2.5 years, it crossed its own average just 15 times. Emerson and Honeywell crossed 41. Its standard deviation is 3 times larger. That is not a worse pair. That is not a pair. An optimizer will always hand you a number. Whether the number means anything is a separate question, and this procedure is what answers it. So the same routine is both a coefficient calculator and a rejection test. One button doing two jobs. The beta method can't do this. Beta is always computable for any two stocks whatsoever. It will hand you a hedge ratio for two companies that have nothing to do with each other. That is the decisive difference. Which settles it? For deciding the optimal investment ratio, the common trend model with a co-integration coefficient is more effective than the market model with beta. That fork we left standing in part 9, beta and the co-integration coefficient share a formula but not their ingredients, gets its verdict here. One reservation, and I want to be straight about it. That verdict rests on having fewer assumptions, not on a head-to-head test of the two. Last question. Why is minimizing the autocorrelation the same as maximizing stationarity? To see it, you only need one time series model, the AR1 model, autoregressive. The model is very simple. The current value is roughly the previous value multiplied by some constant A, give or take a residual. That's the whole thing. Look back only one step and it's AR1. Look back further and it generalizes to ARP. Today, only AR1. That constant A is the whole story. For the series to be stationary, A has to sit between -1 and 1. Outside that range, it stops being stationary and becomes a diverging random walk. Let me show you in a spreadsheet. Identical residuals every time. Only it changes. So any difference you see comes from A and nothing else. When A is 0, you just get the residual itself. It never leaves half a unit. When A is 0.5, it oscillates gently. The amplitude grows a bit to about 0.73, but it stays penned in. Highly stationary. When A is 1.005, a hair over 1, the series diverges. 200 steps in, it's out at 10.9. Same residuals, more than 20 times the range. Non-stationary. So, the closer A is to 0, the smaller its absolute value, the more stationary the series, which means that if a pair's trading spread follows an AR1 model, then the smaller A gets, the more stationary the spread. Which leaves exactly one question. What is A? There are two ways to derive this, and they could not be more different. First path, Use the stationarity condition to compute the variance of an AR1 process, then the covariance. Put those together into the autocorrelation at lag 1, and out comes A, exactly. Second path, completely different angle. Find the A that minimizes the sum of squared residuals of the AR1 model. Ordinary least squares, the same machinery as regression. Work it through and you get the autocorrelation again. Two different roads, the same destination. So the chain closes. 4 lines. 1. The smaller A is, the more stationary the AR1 process. 2. A equals the autocorrelation at lag 1. 3. Therefore, the smaller the autocorrelation, the higher the stationarity. 4. Apply AR1 to the spread, and the smaller the spread's autocorrelation, the more stationary the spread. What started in Part 11 as an experimental observation, that two curves bottomed out at the same place, closes here as theory. And now, the most satisfying sentence in this series. What we just did, estimate the coefficient of an AR1 process and judge stationarity from it, has a name. It is the principle of the Dickey-Fuller test, the DF test. Remember Part 10. I introduced the ADF test, said the theory behind it was beyond the level of this series, and taught you how to run it and how to read the output. That black box, we just built it ourselves in a spreadsheet, so let's point it at our own spread. The DF test returns a score, and at the 5% level, the threshold is minus 2.86. You have to be below that line to call a series stationary. Hedged 1-to-1, our spread scores minus 2.69. It does not clear the line. It fails. Hedged 1 to 1.74, it scores minus 3.34. It passes. Same two stocks. Same period. Same data. The only thing that changed is the ratio. And the verdict flipped. The coefficient didn't just make the chart look tidier, it moved this pair across the line that decides whether it's tradable at all. Judged at 1-to-1, we would have thrown Emerson and Honeywell away. Swap AR1 for a more general model, ARP or ARMA, and that is the principle of the ADF test, the augmented Dickey-Fuller. Academic work uses ADF to pin stationarity down rigorously. For the practical business of pairs trading, the DF principle you just learned is enough. And that last part is a practitioner's judgment, not a theorem. Let me pull it together. 3 lines. 1. A 1-to-1 hedge may not be market neutral. If the common trend doesn't cancel, a trend stays in the spread, and that trend is risk. The real ratio is the one that minimizes the spread's autocorrelation, and Solver will find it for you. Though I should say, 1-to-1 isn't always wrong. For genuinely tight pairs, the coefficient comes out near 1 anyway, which is what we saw back in parts 8 and 11. 2. That coefficient is the multiplier that erases the common trend. The beta root demands 2 assumptions. The common trend model takes none and reads the answer out of the data. Don't start from your assumptions, start from the result you want. That was today's frame, and the same procedure that hands you the coefficient also throws pairs out. AT&T and Verizon got thrown out right in front of you. 3. The autocorrelation is the coefficient A of an AR1 process, and the smaller A is, the more stationary the series. That's the principle of the DF test. We built the tool Part 10 left in a black box, and then watched it flip its own verdict on our pair because of one ratio. And let me plant a marker here. The theory for handling a single pair is finished as of today. How to test whether it qualifies, from Part 10. How to measure its risk, from Part 9. How to set the coefficient, the entry line and the window, from Part 11. What the relationship actually is, from Part 12. And today, the ground underneath all of it. From the next part, the question changes. What happens when you run several at once? In Part 8, we talked about running 2 monitoring screens. In Part 12, we built a screener that cuts 120,000 candidates down to 1,000. This is where those two meet, multiple pairs trading. One last thing, and I mean it. Today was about how to estimate a hedge ratio. It is not investment advice. The tickers were there to show a procedure, not as recommendations. The trade was one round trip checked by hand, not a backtest. and it ignored costs, borrow, and dividends. And finding the best coefficient today is no guarantee the pair stays cointegrated. A pair that passes this year can look like AT&T and Verizon next year. The call is always yours. If this helped, a like and a subscribe go a long way. And tell me in the comments, is your hedge ratio still 1-to-1? See you in the next one.